Welcome back to the Daily Crypto Roundup. It's Monday, and today we're coming off one of the strangest, most emotionally charged stretches the crypto market has seen in a while. Prices are shaky, sentiment is shot, headlines are swinging between outright panic and aggressive long-term optimism, and once again we've got a mix of institutional conviction, retail fear, regulatory drama, and outright chaos all happening at the same time. If you've opened your portfolio over the past few days and thought, "What on earth is going on here?" You're not alone. Bitcoin has struggled to hold recent highs, altcoins have been under pressure, and yet when you zoom out and look at what's actually happening under the surface, the story is far more nuanced than just the market is crashing. We've got analysts calling this the weakest bear case in Bitcoin's history. We've got sentiment indicators flashing extreme fear at levels we rarely see. We've got regulators quietly backing down after being forced into transparency. We've got exchanges making errors so large they temporarily break local markets. And we've got real-world assets like diamonds being tokenized on blockchain rails, while people on social media are calling crypto dead for the 100th time. So today, we're going to walk through what actually matters, what's noise, what's signal, and what investors should really be paying attention to right now. Before we get into today's stories, let's take a quick look at where the market is trading right now. And just a reminder that these coin prices are sponsored by Ledger, the hardware wallet used by millions to securely store their crypto offline. As we record, Bitcoin is trading around $70,900. Ethereum is sitting near $2,105, while the major stablecoins, Tether and USD Coin, are holding steady right on the $1 peg. Binance Coin is changing hands around $645. XRP is trading near $1.43, and Solana is hovering around $87. Rounding out the rest of the top 10 by market cap, Tron is trading near 28 cents, Dogecoin is just under 10 cents, and Cardano is sitting around 27 cents. Those are the top 10 crypto prices right now, sponsored by Ledger. And as always, remember, prices move fast, so consider these a snapshot of where the market stands as we go into today's roundup. It's also worth noting, the Crypto Fear and Greed Index has collapsed into extreme fear territory, printing single-digit readings. To put that into context, this isn't just people are nervous. This is full-blown pessimism. This is traders expecting lower prices almost by default. This is the kind of environment where people stop looking for reasons to buy and start looking for reasons to sell or stay out altogether. Historically, these kinds of sentiment readings don't show up during the middle of euphoric bull runs. They show up during capitulation phases, during exhaustion, or during moments where uncertainty overwhelms logic. That doesn't mean prices immediately reverse, but it does mean the emotional imbalance is becoming extreme. And what's interesting this time is that sentiment has collapsed far faster than fundamentals. Bitcoin is not dealing with a major protocol failure. There hasn't been a systemic exchange collapse on the scale of FTX. There hasn't been a catastrophic regulatory ban that fundamentally changes how crypto operates. Instead, we're seeing fear driven by macro uncertainty, short-term price action, and positioning unwinds rather than structural damage. That's exactly why some analysts are stepping in and saying this sell-off looks emotionally driven rather than rational. Bernstein, one of the most widely followed firms covering digital assets, put out a note describing the current downturn as potentially the weakest bear case Bitcoin has ever faced. Their argument is simple. When you strip away the noise, the long-term adoption story hasn't broken. Institutional infrastructure continues to build. ETFs still exist. Corporate treasuries still hold Bitcoin. And the underlying network continues to function exactly as designed. Bernstein maintained its long-term price target of around $150,000 for Bitcoin by the end of next year, arguing that nothing about the current pullback invalidates that thesis. They acknowledge volatility, they acknowledge fear, but they don't see a fundamental reason why Bitcoin's long-term trajectory should be derailed by this period of weakness. That doesn't mean they're saying prices go straight up from here. What they're saying is that from a risk-reward perspective, panic selling into extreme fear has historically been one of the worst strategies investors can adopt. And this is where psychology becomes more important than charts. When sentiment is this bad, every bounce gets sold, every rally is treated with suspicion, and every negative headline gets amplified. That's exactly the kind of environment where weak hands exit, and patient capital starts positioning quietly in the background. We're already seeing early signs of that. Several desks have noted that so-called value investors are beginning to re-enter the market. These aren't day traders chasing momentum. These are funds and longer-term allocators who wait for dislocations, who wait for sentiment to collapse, and who are happy to build positions slowly while the crowd is distracted by fear. At the same time, retail behavior tells a very different story. Search trends for terms like Bitcoin capitulation and crypto crash have spiked, while engagement around bullish narratives has fallen sharply. That divergence between professional positioning and retail emotion is something we've seen before, and it rarely resolves in the way most people expect at the time. Now, zooming out slightly, we also need to talk about macro events, because crypto doesn't trade in a vacuum. Over the weekend, Japan delivered a political result that sent shockwaves through global markets. A decisive election outcome boosted confidence in aggressive fiscal stimulus, pushing Japanese equities to record highs. The Nikkei surged, liquidity expectations rose, and risk assets globally reacted almost immediately. Bitcoin briefly pushed higher during Asian trading hours, touching levels above $70,000 before pulling back again. Gold also surged, highlighting something important here. This wasn't just a crypto-specific move. This was a liquidity and confidence-driven reaction across asset classes. That tells us that Bitcoin is still behaving like a global macro asset during moments of liquidity expansion and contraction. When confidence rises and money looks for places to go, Bitcoin reacts. When uncertainty dominates, Bitcoin gets sold alongside other risk assets. But again, that doesn't mean the long-term case disappears. It means short-term price action is being driven by flows rather than fundamentals. And while all of this is happening, the regulatory landscape continues to shift in ways that don't always make headlines, but matter deeply over time. One of the more important stories to come out recently involves the FDIC in the United States. After years of quietly denying it, regulators were forced through legal action to acknowledge the existence of so-called pause letters sent to banks. These letters encouraged financial institutions to limit or halt services to crypto-related businesses without any formal rulemaking or public accountability. In other words, backdoor debanking. After being challenged through a Freedom of Information Act lawsuit, the FDIC agreed to settle, pay legal fees, and commit to greater transparency going forward. This isn't just a procedural win. It's a signal that the era of quiet, informal pressure campaigns against crypto firms may be coming to an end, or at least becoming harder to sustain without scrutiny. For the industry, that matters. Access to banking rails is one of the most important bottlenecks in crypto adoption. When regulators are forced into the open, it becomes harder to selectively target industries without clear justification. Now, while regulators are being pushed toward transparency in some jurisdictions, exchanges are still reminding everyone why trust and operational risk matter. South Korea's Bithumb made headlines after a catastrophic internal error led to users being credited with tens of billions of dollars worth of Bitcoin by mistake. The error triggered panic selling, price dislocations on the exchange, and an immediate regulatory backlash. This wasn't a hack. This wasn't an exploit. This was a systems failure. And it highlights a truth that often gets overlooked during bull markets. Centralized exchanges are still single points of failure. Operational mistakes, internal controls, and basic accounting matter just as much as security. Regulators in South Korea have already signaled that they intend to tighten oversight following the incident, and this kind of event only strengthens the case for self-custody and decentralized infrastructure over the long run. As we mentioned earlier, get your Ledger hardware wallet using our link below before something like this happens to you. Which brings us neatly to one of the more constructive adoption stories of the day. In the UAE, a project has moved forward to tokenize over $280 million worth of physical diamonds using blockchain infrastructure connected to Ripple's ecosystem. The diamonds remain physically stored in secure vaults, but ownership and transfer are handled on-chain. This is exactly the kind of use case that gets drowned out during market sell-offs, but quietly builds the foundation for future adoption. Real-world asset tokenization isn't about memes or speculation. It's about making traditionally illiquid assets more accessible, more transparent, and more efficient to trade. Whether it's diamonds, real estate, bonds, or commodities, this is one of the areas where blockchain technology has a clear, defensible advantage over legacy systems. And while price volatility grabs attention, infrastructure like this continues to develop in the background. Now, let's talk about one of the most closely watched institutional players in the space, because their behavior often acts as a psychological anchor for the market. MicroStrategy, now rebranded simply as Strategy, has continued to buy Bitcoin through this downturn. The company added over 1,000 Bitcoin recently, bringing its total holdings to well over 700,000 coins. On paper, the firm is sitting on billions in unrealized losses due to its high average acquisition price. And yet, analysts continue to rate the stock as a buy, viewing it as a leveraged bet on Bitcoin's long-term recovery. This is important, not because everyone should copy this strategy, but because it shows conviction at scale. Strategy is not trading short-term price moves. It is positioning around a long-term thesis that Bitcoin remains a superior store of value over decades, not weeks. When companies like this continue to buy during periods of extreme fear, it sends a signal. Not a guarantee, not a promise, but a signal that long-term capital hasn't abandoned the space. And this brings us to the core question most listeners are probably asking right now. What should investors actually do in this environment? The honest answer is that it depends on time horizon and risk tolerance. Short-term traders are dealing with a volatile, sentiment-driven market where whipsaws are common and conviction is fragile. Long-term investors, on the other hand, are looking at an environment where fear is high, narratives are negative, and prices are well off recent highs. Historically, those conditions have favored patience rather than panic. That doesn't mean going all in blindly. It means understanding that markets move in cycles. Sentiment overshoots in both directions, and the loudest voices on social media are often the least useful when fear peaks. It also means recognizing that crypto is maturing. We now have institutional analysts issuing formal price targets. We have legal challenges forcing regulators into transparency. We have real-world asset tokenization projects deploying at scale. And we have infrastructure continuing to improve even when prices are down. None of that guarantees success, but it does suggest that declaring crypto finished every time prices pull back is increasingly disconnected from reality. As we head into the next few days, there are a few things worth watching closely. Does sentiment remain pinned in extreme fear, or does it stabilize? Do value buyers continue to step in quietly, or do we see another wave of forced selling? How do macro signals evolve, particularly around liquidity and interest rate expectations? And perhaps most importantly, do people start paying attention to fundamentals again once the emotional dust settles? Because markets don't turn when everyone feels comfortable. They turn when pessimism is exhausted. That's where we are right now. Not at certainty, not at clarity, but at an emotional extreme that historically has mattered far more than most people realize at the time. As always, stay patient, stay informed, and don't let short-term noise override long-term thinking. That's it for today's Daily Crypto Roundup. If you found this useful, make sure you're following the show so you don't miss the next update. And as always, we'll see you at the top.